Hello, everybody. Welcome. Good afternoon, good evening, depending on the world we are. Would have, as always, and all of us would have preferred probably to meet in person, not at least because there might be a dinner after my presentation. So usually I would say so. I'm trying to make it a short while kind of presentation to spare us from dinner, not for too long. So I'm very pleased to be here. Thank you for including the paper. So as Marina already said, I'm presenting a paper on the retail response or retail investor response to the zero lower bound. And the paper has joint work with two colleagues from the University of Southern Denmark and the Danish Finance Institute, which is Alexander Standelbauer and Charlene Uhr. Charlene just joined 7 days ago here in Denmark. So it's the first presentation with this affiliation. So welcome, Charlene, to the STU, and it's of course co-authored also with Michaela from Columbia Business School, the MBAR and the CEPR. And what we're obviously doing in the paper is actually trying to pin down how and to what extent retail investors react differently than to before when the interest rates actually reached the zero lower bound. And in Europe, the zero lower bound was reached a couple of months and years later than in the US. So the ECB lowered the main refinancing operations to the zero lower bound in March 2016. And this main refinancing operations are actually the main interest rate that is usually featured in the newspapers and also featured in the media. And it's been usually like the interest rate we have been teaching our students about when we're talking about monetary policy and all these kinds of things. Now, in the financial crisis, in particular in the aftermath of the sovereign debt crisis in Europe, there have been two interest rates that have been of interest, both in research and in practical policy making. The one is the main refinancing rate, which is like a little bit longer interest rate, and the second rate that is of importance is the deposit facility rate that was already lowered to zero to stimulate the interbanking market in early 2014. And for those of you who are a little bit more into this microfinance literature, probably know the RFS paper by Florian and co-authors, who actually uses the deposit facility rate. So now, why are we, or what is the decision between the two we're taking? So the main refinancing rate is closer to clients. It's going to affect their savings and the interest rates that the banks charge more for two reasons. First of all, it's more relevant to the banks. And secondly, because it's later than the deposit facility rate, it's likely that it quicker or sooner triggers down into the portfolios and the interest rates that the bank sets to the clients. And if you talk to the guys at the ECB, and that is what I did a couple of weeks ago, then they make another point which I haven't been as aware of before as I am now. So basically, in the press conference, Mario Draghi, when he announced the lowering of the main refinancing rate to zero, he says, and that is something that he said several times, he expects that to remain at the present or lower levels for an extended period of time. That refers to the interest rates per se. And then there's a new part of the phrase that he adds, and he says that and continues, and well past the horizon of our net asset purchases, which actually at that point in time meant, by lowering to 2016, giving a preview of the interest rates, that we were talking about this level of interest rates well into 2018 at the earliest, potentially even into 2019. So basically, it was not only giving forward guidance, but the forward guidance was also extended to a much longer future. So people would need to be more wary about what to do with their finances, because it was not just a transitory shock that will vanish within a couple of days or month. So what are we doing in our paper? So we're asking the question, how does this change to the zero lower bound actually affect individual investors' portfolios and consumption? And we use a large sample of German online brokerage clients that were strict to the period from 2010 to 2018, where we observed the full security trading records and all the bookings in their current savings and term money accounts to be able to actually grasp what the people are actually doing differently with the portfolio and with the money after the introduction of the zero lower bound. And what we find is that when the interest rates are going to zero, investors stronger than before offset the passive positive growth in their portfolio by trading out of the market and reinvesting less of the market. So they actively rebalance out of the market. And if they are paid dividends, they reinvest less of the dividends or make a smaller active contribution. Secondly, investors actually take the money out and hoard the money in the cash account instead of consuming out of it, which would have been like the thing that probably ECB would have had in mind. What we surprisingly to our minds, maybe it's a positive thing, not find, is strong asymmetries between different investors with different financial sophistication, with different levels of wealth, with different ages, which come from a dynamic asset allocation model. We would think like interest rates might have a different effect on people in different age cohorts. And last but not least, there's also less or hardly any effect that we find on basically the intensive margin and people reallocating money to high yield instruments, for example. So when we look at the literature, there's a bunch of literature that looks at banks and how they're funding and the question of how non-banks such as insurance companies, non-bank money market funds, and so on actually react to the zero lower bound. And there are two things that are actually kind of interesting. The one is like if you're a non-bank, they seem to move money into the region for yield behavior. And if you talk to banks and look at banks, they're obviously trying to find ways to offset the negative interest rate by their firm strategies, or by even trying to get people and some banks into the stock market. So basically what we actually add with our paper, what we intend to add, is basically providing empirical evidence on the impact of low interest rates on individual investors' behavior. The previous paper, for example, by Caron and Ken Daniel and co-authors, is actually only looking at a period where the interest rate decreases, but at kind of levels that we were used to before. So basically, they document a reaching for yield behavior in the US, which we don't see in Europe and in Germany, and also in behavior that we don't see in our data here. And basically, there has been no evidence on how individual investors react to the zero lower bound in particular, and that is basically what we intend to do, and particularly not if you take like the aggregated data that the ECB owns or the Bundesbank owns. This is basically quarterly data or annual data, and what's also lagging is basically the person view, so that you can fix the person's demographics, or actually see what the single persons do. So in the interest of time, just a very short view at the data. So we work with data set from 2010 to 2018, and we work with about 90,000 clients. These clients are brokerage clients, and like in the Udine data set, they by no means a representative of the average German, but what they are is they're kind of representative of the average online brokerage stock market participators. So we have a strong overhang of males, unfortunately. We do have far more PhDs than we have in the ordinary population. So it's 6% versus 1% in the average. We have relatively old populations in our sample. We have relatively little risk aversion in our sample. When we continue to looking, we have like people on average holding 70,000 euros in their total holdings, a portfolio plus bank account, which is a little bit higher than the average of stock market participators. We also see that our people are, in comparison to other data that we've seen, a bit better diversified in terms of Herfindahl index when we look at a situation that most of, or a lot of these people actually own mutual funds. So what are we looking at? And we're a group of economists, so don't need to talk long about the situation. We're basically looking at, so basically we have experienced in Europe from 2010 onwards, we still saw the Euribor and the main refinancing rate on the rise, whereas in the US it was already tanking. So Europe only had to lower interest rate as a response to the sovereign debt crisis. So we actually look at the event down here in 316, basically, but we also conduct robustness tests using the deposit facility rate, where we see like tendencies going in the direction we later demonstrate on the more important zero lower bound thing. And we also look at the whatever it takes 2012. So you all remember, at least in Europe, the Draghi speech, the ECB is prepared to do whatever it takes, and believe me, it will be enough. We're also looking at that event, and in contrast to the zero lower bound on the deposit facility rate, we always see things going in that direction. the thing on the whatever it takes speech is basically statistically, I'd say, more than insignificant. So what we do in order to see what the reaction of private investors is to reaching the zero lower bound, we actually first need to look at the left-hand side of our analysis, and we use basically three proxies or three variables that are important. The one is we look at a regression inspired by Fight or Flight, the Calvi-Campbell-Zedini monthly paper. We actually are able to disentangle active changes, that the changes that the client do to their portfolio by their own discriminatory trading, and there are passive changes in the portfolio. Passive changes are those changes that were induced by the market from participating. So basically you have the portfolio, and the portfolio changes in value without you trading. What you need to do when the portfolio changes in value, you have a choice: either you stick to that change or you actively rebalance, depending on your strategy and your beliefs and preferences. So basically what we're interested in is how much and in what direction is the passive change set off or change or altered by active changing and by active trading. Remember, in the Calvi-Campbell-Zedini paper, they find that about 50% of the passive changes is actually offset by active trading of the portfolio. So basically, they find evidence for people rebalancing. Then we look at changes in the saving rates, where we, in our setting on the monthly level, just contrast income minus consumption without any flows from the portfolio. And thirdly, we look at cash holdings and the amount of cash holdings as the month's end balance. This is in the sum of the cash accounts that we observe for clients. In the interest of time, see like the tables in a minute. What we're basically interested in is basically the change in two main variables as induced by the zero lower bound, and this is what I have marked in red. So basically what I'm interested in is basically the question of whether a dividend that has been paid out to the client, you can do it in absolute terms or in dummy variables. We tried both. We have the dummy variable specification because we thought it's easier to interpret, but basically you could also use it as a marginal propensity to reinvest dividends. That's euro on euro, basically paints the same picture. And we have secondly the change in the passive change as introduced by the zero lower bound. So asking the question, is the rebalancing changed after the introduction of the zero lower bound, and is this statistically significant? Because we are running that in a panel, in the main specification, we can include investor fixed effects. We can control for all what is dynamic in the portfolio, so portfolio value with lag and all kinds of these things. And we use year and or under other specification month by year fixed effects as in the HIDA paper, and we cluster standard errors at the investor level as to also be in line with the literature. Other clusterings do not do a great deal if you try. This is the one more panel-y specification. Another specification that we run to actually robustify our effects would be saying we look at the short run effects and we just compare the February 2016 to April 2016 and leave out the March of 2016 because we're working basically with month-end balances and what we do with the active and passive changes. And the interest rate change was exactly in the middle of the month, so it's very difficult to tear apart what is happening there. And there's also short run effects, right? So interest rates hits, the market jumps up, and then there's short run like momentum trading effects. So basically we take at the March. And then what we're interested in this specification is basically also the changes in the reinvestment of dividends, so the active change as a response to being alerted and being saline in the portfolio to dividends, and also the change in reinvestments in the passive change. Both actually yield the same results. So basically we focus on the panel regression in most of what I'm doing. So when we come to the results and actually look at what people are actually doing, what we see is that in general, the passive change is actually more or less the same as in the Calvi paper. We're here in monthly instead of yearly figures, so they might be a little bit smaller, but they are negative and they are highly statistically significant. What is interesting to our minds is that people actually rebalance stronger and are more likely to reinvest less of the dividends or have a small active change once they get the dividend after the zero lower bound. So basically speaking, people tend to reinvest less of the dividend or reinvest less as a response to dividend, to be absolutely precise, and to engage more rebalancing. So the market shoots up, so they're kind of more actively taking money out. That also holds in the short run perspective of the more close tracking of the data, what we do. So basically, message dividend payments induces less active changes after the zero lower bound announcement. And secondly, also the rebalancing becomes strong. When we look at the savings rate, so basically salary and all regular income to the account minus consumption has actually have got any statistically significant that is not different from zero when the zero lower bound hits. You can also do it differently and put consumption on the left hand side. Just look at how much people actually consume. That basically paints the same picture. So the question that obviously comes up is, where do people keep and what are people doing with the money they're taking out of the portfolio as a response to the increase in the stock markets? And what we actually find is, if we look at the cash holdings at the ZLB, what we find is that if there's a dividend, like the cash holding of the people jumps up, and also as a response after the ZLB, people also seem to actually save the passive change that they're rebalancing out of the portfolio in their holdings, in their cash holdings, and all of that is controlled by passive and active changes in the portfolio to actually see that the results are not driven by basically portfolio trades, but by people hoarding cash. So now the question becomes, okay, do we find anything in terms of heterogeneity? Is there anything we can get from samples because of financial sophistication, using the diversification as proxy by age and by wealth? What we do find is in both directions, and in all sample splits, basically, if you look down here, depending on age, depending on diversification, or depending on wealth, basically direction remains the same. Also, if you try to test for differences between the two groups, they are all basically the same. So basically, instead of seeing that there is a big difference and increasing gap between rich and poor, what we initially would love to find, we do not find any evidence. So we do one additional analysis where we look at newspaper tone, see whether it is within the preferences of the clients, or whether you can actually explain that to clients. We'll look at the newspaper analysis and differentiate between newspaper with positive tone and negative tone. So basically, newspapers that find the ECB things good, and newspapers that don't like the ECB, those who live in regions where newspapers are more negative, are actually stronger in actually taking money out and hoarding cash. And the whole cash thing we're observing here is also in line with data on annual terms by the Bundesbank, where you also see that over time down here, currency and transferable deposits actually increase, telling us that basically our results mirror what people are doing. As I told you, we look at two alternative events, which basically does not give us much of new evidence. We can actually do robustness checks by just doing those people who get salaries in their account. We can actually change the size of the dividends so that people really have to realize that they got the dividends. Results replicate in both approaches. Because I'm running out of time, what are the main takeaways? Well, when interest rates approach zero, investors partly offset the passive growth in their portfolio, trading out of the market and hoarding the money in cash. After all, there's a bit of good news. The effect is not limited to less financially sophisticated or poorer. So basically, the gap between those two groups as a society is not widened by the zero lower group. On the intensive margin, we're not talking about the difference between participators and non-participators, because we can't. But there's also a grain of salt in all what we've seen. The zero lower bound does not spur consumption or stock market investments, two things that the ECB and the monetary policy makers would probably have loved to see. So basically, the multiplier effect that from these low interest rates could have been going into the economy are not taking full effect. With this, looking forward to David's comments. Thank you very much, and looking forward to the comments.
Okay, thank you very much, Stefan. And now we have David Solomon discussing. Thank you, David.
All right, does the slides look okay?
Yeah.
All right, very good. Thanks a lot for having me along. It's an interesting subject to read about and think about. It was a neat paper to see. So what's the context here? Okay, I think the context is like, this is one of those stylized facts that I think is like way more important than people actually pay attention to, which is that the time series of nominal interest rates is super crazy. It goes way up and, you know, it keeps sort of rising until the Volcker period. And then it comes down, it goes back up in a boom time, but then it seems to come down to every new level. Now it's like, it's going to be zero. Here's the same thing in Europe where these guys are studying it. And you've kind of seen a whole lot of zero and in fact, negative numbers. Okay. Interest rates are low and likely to stay low. I mean, central bankers don't stay forever, but if you were to bet on forever, that's not a bad current estimate of where things are heading. I actually was joking a few months ago with Andreas Stathopoulos. I would very much like to be the first person to get the phrase zero upper bound into a finance journal to describe the new regime. So it's not like you can't go below zero, but in fact, you're never going above zero. In a boom time, maybe you'll get there. Otherwise, it's going to be negative. I think that one of the reasons this is especially important is that this is one of those facts that's known but not widely appreciated. The main obstacle to seriously negative interest rates is the existence of pieces of paper that you can take out of the bank that maintain their face value. But those are totally anachronistic. At some point, the ECB is going to get rid of the paper money altogether, and then they're just going to decide to set rates at -10 to get the economy booming. And it's a fascinating question to think about what people are going to do when that happens. So this is the context. There's a lot of interesting stuff that I think is worth thinking about more. Reading this paper, okay, when they talk about this in the introduction, here's the way they phrase it. They say they're studying the relationship between the zero lower bound, investors' rebalancing decisions as a response to the stock market returns, savings, and cash holdings. Now, that's a lot of stuff, okay? That is a lot of things to be tying together, okay? What is concretely being measured, okay? The main, more narrow subject is how investors are reinvesting dividends before and after April 2016 in Germany. Okay, that's fine. That's the specific progressions. Claims that are made. Investors are hoarding cash more afterwards as a result. There's more active rebalancing after hitting the zero lower bound. This active rebalancing is leading to cash transfers to the cash accounts, and there's no change in savings out of salary, a bunch of other things. Okay. Now, I don't normally spend very much time summarizing papers and where things come from, but I think it took me a little while to piece together where these things actually came from. Okay, so I think this is just like the main table too, and here's, I think, where you get each result from. Okay, this active change is how much you change your portfolio. I think dividend reinvestment would make that positive, but I'm not sure. I think that's something you probably want to clarify, because that's sort of an important detail for what's going on. Do you put more money back into your portfolio after you get a cash payment? Dividend dummy is positive. It says that there's some reinvestment of dividends going on here. But given there's this interaction with a Euribor increase or decrease and with a zero lower bound, this is actually telling you there's some reinvestment if there's no change in interest rates and you're not at the zero lower bound. Okay? This is a dummy, so it's not clear to interpret this in terms of how many cents in the dollar are being reinvested, which is the thing you kind of want to know. It's like, in some sense, any amount going back in is going to consistently will make this positive, but there's a whole lot of how full or empty the glass could be here that's worth pondering. Okay. Then you've got these interactions here. Same dividend dummy interacted with interest rate increase or interest rate decrease. Much is made of this one here. There's more reinvestment when interest rates drop. Okay, you reinvest more when interest rates are going down. But directionally, there's also more reinvestment when interest rates rise, which is sort of, I don't know what is the story here. It's not positive, but sure ain't a negative number, which would be the sort of straightforward story for what's going on. Okay, so I think that's at least a little bit puzzling. The other one, I think the one that's sort of made a lot of, is this zero lower bound times dummy. There's less reinvestment when the zero lower bound is reached. But it's sort of worth thinking about this in the context of the one we just saw. When the interest rates are dropping down towards zero, you reinvest more. When they finally hit zero, you reinvest less. And so it's like both stories are profit, but they're not totally inconsistent, but they sort of point in slightly different directions in terms of thinking about what's going on. Okay. And then the way these things are all phrased, these dividend decisions are interpreted as two things. Firstly, they're interpreted as being active portfolio rebalancing choices. You're making a decision to invest or not. And secondly, they're interpreted as asset allocation decisions that tell you something about attitudes to cash. Now, from the point of view of economics, both are totally correct. Okay, a choice is a choice, whether you actively make it or not, and it's still worth studying. And you end up with an asset allocation that comes out of it. Okay? So there's nothing wrong with that. The only question is, I think probably this is going to be the rest of the focus of my talk. I'm not sure this is how investors are thinking about it. And so it's like the question of then, what are they thinking about and what might be going on here? Okay, first off, are these active choices? Okay. The first thing that's a little bit weird, and firstly, the caveat emptor, this is going to be by an order of magnitude the most self-referential discussion I've ever given, but it just is because I happen to have been thinking about a whole lot of stuff related to this for a while, and everything has become the nail that needs to be hit with the hammer of weird ways investors think about dividends. Okay, but brokerages don't generally tell you when you get a dividend. Okay, the reporting of returns is all sorts of screwed up. Chances are, at least in the US, don't know about this bank, the main way you'll find out you get a dividend is at some point you realize your cash balance has gone up. And that's it. It won't tell you where it's come from. It won't tell you how it aggregates up to a total return. Okay. But I want to say that people are making active choices. And this claim made in the paper at 2 different points. Receiving dividend payments increases attention towards the investment portfolio. Citation, Graham and Kumar, 2006. Okay. Graham and Kumar's 2006 is one of those papers that has like tons of stuff in it. I was reading, I was like, is that in Graham and Kumar 2006? And the answer is, sort of. What Graham and Kumar 2006 actually say is that you're more likely to trade that particular stock around dividend announcements, not dividend payments. Okay. There's no evidence, at least unless I've misread the paper, about what you do with the rest of the portfolio. There's not a sense that like, well, I have to rebalance everything because suddenly the dividend made me think about what I'm holding. It's actually just that when a company announces dividends, you like buying that company. Okay? Graham and Kumar, now the other quibble, which is with Graham and Kumar, not with the authors, is that Graham and Kumar say this is about attention, but there's no evidence that this is about attention. They just say, well, an announcement is attention. It's also totally consistent with investors just thinking dividends are free money, of which there's quite a lot of buying to get the free cash. Okay? If you want to sort of see some evidence consistent with that, here's from a paper with Sam Hart's Market Mind. This is the time series of returns around dividend announcements. You get a big daily return on the announcement and big day-by-day returns afterwards. This is a period where there's no news, there's no tax implications, there's no anything. But people love dividends, so they keep buying. In the lead up to the X day, the price keeps going up and daily returns get bigger and bigger. As soon as the X day is passed, this thing is negative. And that, when you think about the Graham and Kumar result in light of this, what it looks more like is people are buying dividend-paying stocks after they announce the dividend, and it just looks like they love dividends. It doesn't mean that they're thinking a whole lot necessarily about the rest of their portfolio. Okay? So that is at least worth thinking about what's going on here. The other part of it is that there's this sort of sense that dividends are thought about as fungible cash. And I think there's a lot of evidence that this is not true. Okay, investors generally treat dividends as belonging to some kind of separate mental account. This is from Sam and my dividend disconnect paper. And the way you can kind of show this is that when you're doing a whole lot of trades based on like performance, I need to trade based on performance. So for instance, the disposition effect says you sell when you're at a gain and hang on when you're at a loss. What counts as a gain? The answer is price changes. It's not dividends. They tend to get left out of that calculation altogether. Again, it doesn't mean this is not an asset allocation decision. It just means that people are probably treating this cash as being special. There's also this finding in Baker, Nagel, and Wergler that investors generally consume dividend proceeds rather than investing them. Okay? And so all of this, if you think that if this were your benchmark for what dividend reinvestment is about, there's this puzzling claim that people are trying to reinvest less or reinvest more. It sort of shifts at various different points, but there's not a good theory of what's going on. It's like, I don't know what I expect these guys to be doing. But I think that that was the big sort of missing piece here, is a sense of like, well, what, even as asset allocation, but just certainly as dividends, what are these guys thinking about as they're doing these trades? And And I think this might also explain why there's very little effect that you find on savings or other rebalancing stuff, which is like, well, if you're trying to hoard cash, maybe you should sell some risky assets to keep some cash. But if your hoarding cash is just about like, well, leaving little dribs and drabs of dividends in your portfolio for longer, is that really a cash allocation decision, or is this just telling you something about your attitudes to dividends? Okay. The other aspect of this is you're thinking, well, okay, well, the other part here is that this zero lower bound component, which is quite interesting. But when you think about the time series of what's happening, most of the shift is going from interest rates being almost zero to interest rates being exactly zero, which you might not expect to be a big and dramatic thing. Okay, this is not the deposit rate, but this is the one I could find, the Euribor one. You see that this thing, ever since like 2012, it's like being zero or not very much for quite some time. You might expect some change there, but there's not a ton. Okay? The investors, the authors have thought about this. One of the, because you're trying to distinguish between stuff going on here and stuff going on here, and assuming that not much else is changing, which may or may not be true. So then they say, well, let's do better than this and focus on the difference between February 2016 and April 2016 as a tight test of the time. These are just 2 months that are close together. Okay? Question is, what else changes between those 2 months? And the answer is, if you're talking about German stocks, there's way more German dividends paid in April than are paid in February. Okay, the German dividend distribution is unusually concentrated. US dividends are paid more or less throughout the year. Germany, most of the action is in May. The rest of it is in April and June. Okay? And when you're thinking about a dividend dummy, you're not really going to identify these effects. So why might it matter? Well, suppose that because the amount of people being affected is one, but also just the total amount of cash you're receiving is going to be very different. Okay? If you're in February, when there's so few companies paying, then you're just not going to get very much money. Whereas if you get a big chunk all at once in April, maybe you just decide that now it's time to buy a flat screen TV. Okay? So that's something else you may be thinking about. Now, I know the authors have thought about this distribution of dividends because they talk about it a little bit in the paper. This is the graph of like monthly payout yield in German stocks, which I don't know that they have, but if investors are trading German stocks, here's what it is. Here's April. It's like a big number. May's the big number. Here's February down here. The sentence in the paper, which I thought was quite of an interesting one, they say, in our sample, dividends are paid out in all months throughout the year. Now, your mileage may vary as to whether you think that sentence is a good description of that graph. It is definitely in the technically true category. There is some non-trivial bar in all 12, but I think I would try and tackle this issue a little bit better. There are other things going on even just between these 2 months. And then without trying to beat a dead horse here, the other part that they kind of talk about is like, well, what else could this zero lower bound be telling us? They say dividends are known to be sticky because managers are reluctant to change dividend payments. Therefore, it's improbable that dividend payments are endogenous to the zero lower bound. And this is true. Managers generally don't like to change dividend payments. Okay? But even if dividends aren't changing, attitudes towards dividends are likely to be changing. Okay? And there's a bunch of papers that look at this. Okay? Demand for dividends is higher in recessions. It's higher when the VIX is higher. There's 2 papers that show that demand for dividends is higher when interest rates are lower. Now, they're not looking at zero, so it's not like there's nothing new here. But this idea that interest rates are relevant for dividend demand is definitely there. Now, the authors are doing something different. They're not looking about how much do you desire dividends, but what do you do with the money after you get it? And so there's like, it doesn't follow from that immediately what the answer to that question is. But I think you want to think about it in that context. If we know that they're doing this strange dividend demand more in these kinds of times, should this inform our priors as to what this is doing for what they do with the proceeds? Okay. So answer here, punchline at the end, I think there's this interesting puzzle and these interesting results they find about investors reinvesting dividends differently when interest rates are hitting zero. Okay, I think I'd probably just push them a little bit on this sense of what we should think about. It depends on whether you think about this as being an asset allocation cash decision or something dividend specific. But either way, a lot to think about. Interesting paper.
Perfect. Thank you so much, David. Learned a lot about dividends. That was awesome. So Stefan, do you want to quickly respond to any comments, and then we can open up for questions?
Yeah, just very quickly. I read a lot of David's work with relation to dividends. Still, I learned quite a bit too. Obviously, no kidding. So, David, big thank you. A lot of interesting points to think about and to be more specific about in the paper. Would love to have the slides. So maybe just 2-3 points to be specific about. So those guys. Those banks here actually seem to report, at least we talked with them, a slip in via email to each of the clients who got an email also for tax purposes. So obviously they do get an information that they received a dividend, but we need surely to be more specific about it. And with your point of whether people realize the dividends and actually care more, we do have for some time before 2016, we're just waiting for the new data to come, login data. We can actually see whether people are kind of more likely to logging in. So that is something we should definitely do. I very much appreciate the comment of the mental account. What we have in mind though is that people do get a dividend. And they did get a dividend before the zero lower bound and have a particular behavior, whether they do get a dividend after the zero lower bound and actually whether they change their behavior doesn't mean that they if it gets in their different mental accounts could be like heterogeneous across groups. But actually what I have in mind is something like a common trend, but something that we need to make sure. One thing that I can't let go like this is basically we have thought about this dividend cycle within the period, and we should definitely include the table in the paper where we restrict like the amount of dividend and the share of people with dividends. What we meant is we try to look at the share of people in our sample that who do get a dividend in a particular month. And that did not look by no means as skewed as the one that you showed for the month of February. But it's definitely a point we need to be more specific about. Another thing that we kind of, depending on which discussion we get, is basically whether we should include the dividend demand or not. If we talk about the high yield stuff, Kai Rong and Kent and all the others have a paper where they look at dividend strong stocks and see whether the active change goes towards these stocks when the zero lower bound hits, and we actually do not find any of additional allocation to these high dividend stocks at the zero lower bound or when the interest rates decrease. And the last point that is well taken, we should go for using euros to give like people a sense of the amounts that are going on there. So thanks a lot. We'd love to have the slides to actually tick off boxes and see that we answered all the points because they're super important. Otherwise, looking forward to the questions from the audience.